So, you want to start investing in the stock market. Or, maybe more likely, somebody told you that you should. Only problem is, you have no idea where to start. Don't worry, that's okay, I felt the same way. But that's why we're here, so let's get started. The first question we have to ask ourselves is, what even is the stock market, and why should you care? Instead of throwing a bunch of terms at you like a textbook, let's start with an analogy. Imagine a man walking his dog. This dog is crazy and has way too much energy, darting left and right randomly all over the place. A crowd gathers around the man and his dog, all trying to guess where the dog will go next. After a while, the crowd notices something. While the dog's movements have seemed completely wild, his straight path from start to finish goes exactly 10 miles northeast. Surely this can't be right, the crowd says. They watch for a while longer. The dog darts left and right just as randomly as the first time, but once again, at the end of its path, they notice the dog is yet another 10 miles northeast. This steady long-run growth is the overall stock market. The short-term movements are sporadic and extremely difficult to predict, but if you invest at the beginning and check in at the end, you will see an average growth in the long run. Specifically speaking, this example is the S&P 500. This is an index that invests in and tracks the performance of 500 of the largest companies in the United States. And it's also one of the most common choices for the average investor. It has averaged a return of 10% annually since it was first created in 1926, and yes, that's almost 100 years ago. My point is that if it's returned an average of 10% every year for almost 100 years, despite things like this, and this, and this, and this, then I would say we can pretty reliably expect it to continue doing more of the same. The stock market isn't just one big index for the largest companies, though. The beauty of the market is that it allows you to pick and invest in your favorite companies, decide your own personal risk tolerance, and help you grow your wealth, all while being as passive or as active as you choose it to be. Now that you know what the stock market is, let's get to the more important part. Why should you care? What I'm about to illustrate are the 3 most important things that I want you to take from this video, and maybe from anything I ever say on this channel, so listen closely. Number 1. Time in the market beats timing the market. This is a classic phrase in the world of investing, but the importance of starting your investing career as soon as you turn 18 is crucial. Number 2. You must continue to contribute to your portfolio. As you'll see in a minute here, small contributions each month will make or break your portfolio in the long run. And number 3, we are here to invest long term. This means buy and hold. Once you establish your portfolio, you can use a small percentage to trade and play options as I do, but the main component will always be your long-term holds. If you don't actually believe how incredibly strong this stuff is, let's go to an investment calculator because the numbers never lie. Alright, so here we have an investment calculator. So let's just assume for argument's sake that you start with $1,000. If you start as soon as you're 18, we'll say that you're going to invest for 60 years. And let's say that you continue with the S&P 500 rate of 10% a year. But let's say you don't contribute anything additional. Let's say you just wanted to invest the $1,000 and just go from there. So that would net you, after 60 years, you'd have $304,000, which, don't get me wrong, that's a good chunk of money still. Let's say instead you contributed $100 every month, but you only had 30 years to invest because you started late. Where would that get you? Well, that's going to get you $223,000. What's my point here? So that first example, we didn't continue to contribute. That second example, we chopped years off of our investing life. Let's do them both. Starting amount same, return rate the same, but you take all the years and the additional contribution, and you would end the 60 years with $4.1 million. Yeah, million. $4.1 million. It's a lot of money. Well, ladies and gentlemen, thank you for attending Lesson 1. Feel free to leave any questions you have in the comment section down below. If you learned something, drop a like on the video. Consider sharing this video with somebody else you know that could use this information. And most importantly, subscribe to the channel and tune in next week for Lesson 2. How do you actually start buying and selling stocks? Thank you for watching. We'll see you next week.